stock split euphoria. Everybody's talking about it. Wall Street's buzzing, but is it really all it's cracked up to be? More importantly, should you even care?
Right.
That's what we're going to dive into today. We're going to unpack Sony's recent stock split, see what it means, if it even means anything for investors, and maybe even do a little speculating about whether or not another tech giant might be gearing up for a similar move.
Yeah, it's like the stock market's version of whisper down the lane.
Right.
So one company makes a move, and suddenly everybody's looking over their shoulder wondering if they should be doing the same thing.
Exactly. So Sony, they completed a 5-for-1 stock split on October 9th, 2024.
Oh.
So basically, they took their share price, which was at the time around $95, and they just chopped it divided by 5.
So now it's down to a more manageable $19 a share.
$19.
Which on the surface feels like you're getting a bargain.
Right.
But the thing is, a stock split doesn't actually change the fundamental value of a company.
Right.
It's like taking a pizza, and instead of cutting it into 8 slices, you cut it into 16 slices.
Yeah.
You don't have more pizza.
You just got smaller pieces.
Exactly.
So the question is, why bother? Why would Sony, a company that's, at the top of their game, why go through the effort?
Well, this is where the psychology of it comes in, because a lower share price can be really enticing, especially for retail investors. Somebody who maybe thought, well, $95 a share, I don't know if I can swing that.
Right.
But $19, that's a lot easier to stomach.
Yeah.
And so there's this psychological barrier that kind of gets broken down when something's perceived as more affordable, even if the overall value hasn't changed.
Yeah, it's like the stock market equivalent of like a Black Friday sale.
Yeah, exactly.
Next product just seems more accessible.
Mm-hmm.
So is this a play for Sony to try to attract a wider range of investors?
I think that's a very real possibility, and it's a smart strategy if it is.
Yeah.
Because generally speaking, the more investors you have in a company often leads to a higher trading volume, which in turn can increase demand and drive the stock price up.
So it could be a win-win.
Exactly.
For both Sony and for those investors who maybe got in because it was a little bit easier to get at.
Right.
But let's zoom out a little bit, because stock splits aside, Sony's got some pretty serious strengths going for it.
Oh, absolutely. I mean, their gaming division is on fire right now.
Yeah.
I mean, the PlayStation 5 is still dominating the console market.
Hugely.
And I don't know if you saw this, but they actually just announced a 19% price increase for the PS5 in Japan.
Whoa.
Which is a bold move.
That is a bold move.
For a console that's been out for a little while now.
Right.
That says to me they are very confident in their market share and that the demand is still there.
Yeah, no kidding. They must not be too worried about scalpers anymore.
Right.
But it's not all about gaming for Sony.
Not at all.
They've got their hands in a lot of different cookie jars.
They do. They've got their fingers on the pulse.
Imaging and Sensing Solutions, or ISS, as I guess the finance people call it. They're kind of a silent giant in the tech world.
Yeah, they fly under the radar a little bit, but they're a powerhouse.
They're the ones making those like super high-tech image sensors that are in like every smartphone.
Exactly. Every smartphone, every digital camera. A lot of these devices that we rely on every day are using Sony technology.
Wow.
And the global demand for these things, it's not going down anytime soon.
No.
So this segment of Sony's business is just going to keep growing.
Right. And that's a really good point to bring up, because that just shows that they're not a one-trick pony.
Exactly.
They're diversified.
Diversification is key, especially in the tech world.
Right, because you never know what's going to be, the next big thing.
Right. Who knows what's going to be obsolete tomorrow.
Yeah.
So it's smart to have your eggs in a few different baskets.
And speaking of having your eggs in different baskets, let's talk about us for a second, the investors.
Okay.
Sony's got a pretty good track record when it comes to making sure that their shareholders are happy. They're all about returning value back to the people who are invested in their company.
Absolutely.
It's like they're saying, hey, we're not just a gaming company, we're looking at the bigger picture.
Right.
But, speaking of keeping investors happy, Sony's got a history of, taking care of their shareholders.
Absolutely. They have a very shareholder-friendly capital return program.
Okay, so break that down for me. What does that actually mean, like in, plain English?
Basically, it means they're actively looking for ways to put money back into the pockets of their shareholders.
I like the sound of that.
Right.
So how do they do that?
Well, one of the most common ways is through something called stock buybacks.
Okay, I've heard of those.
Essentially what happens is Sony will go out and repurchase some of its own shares from the market.
Okay.
And by reducing the number of outstanding shares, it can actually increase the value of the remaining shares that are held by investors.
So it's like they're saying, we believe in our company so much we're willing to bet on ourselves.
Exactly. It's a vote of confidence.
I like it. Smart move, Sony. But this whole conversation about stock splits, it got me thinking about another tech giant, Meta Platforms.
Interesting you should mention that Meta actually has never split its stock.
Never.
Never.
Wow.
And their shares are currently trading at over $600 a pop.
$600 compared to Sony's, what was it, pre-split, like $95?
$95. Yeah, that's a big difference.
So are you saying that Meta could be like next in line for a stock split?
They certainly fit the bill. I mean, a stock split could make their shares accessible to a much wider range of investors.
That's true. Because $600 is, that's a pretty steep entry point.
It's a barrier to entry for a lot of people.
Yeah.
And don't forget, we're talking about the company behind Facebook, Instagram, WhatsApp.
Oh, yeah, they're not messing around.
I mean, billions of daily active users across those platforms.
Global domination.
Pretty much.
Yeah.
And that translates to massive advertising revenue potential, not to mention the influence that they have in the digital world.
For sure. And they're not just sitting back and relaxing either, right? Meta's putting a lot of their resources into things like AI and the metaverse.
Oh, absolutely. They're not shy about investing in the future. They're really trying to position themselves at the forefront of these emerging technologies.
Yeah, it's like they're sending a message that they're not just a social media company. They're like pioneers shaping the future of how we connect with each other.
And these investments that they're making in things like AI and the metaverse, those are potentially huge growth areas for the company.
It's like they're planting seeds for future success.
Exactly.
And those seeds are being planted in some pretty fertile ground.
Right. And let's not forget the fact that Meta is sitting on a mountain of cash.
Oh, yeah, that's right. They've got money to burn.
They have so much financial flexibility. They can make acquisitions. They can invest heavily in research and development.
Yeah.
They could even decide to start paying dividends to shareholders.
It's like they've got all the cards.
They're in the driver's seat, for sure.
Yeah, they're in the driver's seat.
Yeah.
They're calling the shots.
That's right.
So when when we kind of pull back from the spreadsheets and all the stock prices and all that stuff, what's the big takeaway here? What should we be, hearing from all this talk about stock splits?
Well, I think the biggest thing is don't get caught up in the hype. Don't just follow the herd. You really got to do your homework.
Right.
Look beyond just the headlines and ask yourself what's really motivating this move.
Mm-hmm.
Is this a company that's just trying to, dress itself up to look more appealing? Or is it a strategic decision that's aligned with a long-term vision?
It's like we're trying to decipher some sort of like secret code here.
Kind of.
We're looking for those little hints, those little clues to see, if a company is actually worth investing in.
Exactly. Because just because a company splits its stock doesn't mean it's going to be successful.
Right.
It's about the bigger picture. What are the fundamentals of the business? What's their growth potential? Are they committed to creating value for their shareholders?
So as we wrap up our deep dive here, into the world of stock splits, what's the big lesson here? What do we want our listeners to take away?
I think the biggest thing is knowledge is power. The more informed you are as an investor, the better decisions you're going to make.
Be informed. Be a savvy investor.
Exactly. And sometimes the most interesting stories aren't the ones that are splashed across the front pages.
Right.
It's the subtle moves. It's those strategic decisions that companies make that can really tell you where they're headed.
Yeah, it's all about connecting the dots, right?
Yeah.
Trying to understand their motivations and ultimately making decisions that make sense for you as an investor.
Exactly. Your money, your future, your decisions.
It's your money at the end of the day. So, dive deep, ask questions, and never be afraid to kind of push back a little bit.
Be bold.
Yeah, that's how you make it in this world, this crazy world of investing.
And hey, you never know. You might be the one to spot the next big stock split before everyone else.
There you go. That's all the time we have for today's deep dive, but we'll be back next week with another fascinating topic. Until then, happy investing, everybody.
See you next time.